Good morning, ladies and gentlemen, and welcome to the Capital Limited investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Just simply type in your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. These will be available via your Investor Meet Company dashboard, and we will send you an email to notify you when they're ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we would like to submit the following poll and would be grateful if you could give that your attention. And I'd now like to hand over to Giles Everest, CFO, Rick Robson, Head of Corporate Development, and JB Boyden, Chairman from Capital. Good morning to you all.
Good morning. Thank you very much, Mark. And I'd like to welcome everyone to the Capital Limited 2020 annual results call. As mentioned in the introduction, I've got Giles Everest, our group CFO, and Rick Robson, Head of Corporate Development, with me. Both Giles and Rick are based in London, and they'll be here to assist and answer questions when we get to the Q&A portion of the presentation. I'll kick off and run through the slide deck. We obviously announced our results last Thursday, and a very good set of numbers, but we'll start with an introduction to the company for those that aren't familiar with Capital. We'll then go through the results, and then move into the strategy and outlook for 2021 and beyond. So I'll kick off on slide 4, which is an overview, a snapshot of the company. Capital is a provider of services to minerals, mining and exploration companies in the African continent. We established ourselves 15 years ago in Africa and started life as an exploration drilling company. And over the subsequent 15 years, we have evolved our service offering to expand into a full range of drilling services. And in more recent times, we've added maintenance services, analytical services, and most recently, contract mining and earth moving services. We currently operate in 10 countries across Africa, which are the dark blue ones that you can see on the slide, in the slide pack. We have operated in the ones in dark grey. We have done contracts in those countries during our history. We have a fleet of 94 rigs as at December 31. The actual average fleet size last year was 98 rigs. We decommissioned some rigs late in the year. And 28 pieces of heavy mining equipment, which is a new business stream for us. To put that rig count in context, it sits us about number 5 globally in terms of total rig count. And we think about, number 1 for a contract drilling company on the African continent. We currently employ 1,300 people, but that number is rapidly increasing with the rollout of our earth-moving contract at Sukari. And we have a heavy prevalence of very high-quality blue-chip customers, the likes of Barrick, obviously the world's biggest gold company. They were actually our first customer all the way back in 2005. AngloGold Ashanti, Kinross, and Centamin. So there's a lot of very high-profile customers with some very high-quality assets. The group's strategy is the delivery of an end-to-end exploration and mining services solution to our customers. We are focused on generating revenue from mine site-based contracts, and there's a number of reasons that underline that strategy. The basic premise is to target key customers with assets that are either in development or early production phase, and to grow our services as the customer grows. And by embedding us and by offering services at the mine site, we tend to transition through from inception, which tends to be either exploration or delineation drilling, and then over time add services. And a case in point is the Sukari gold mine, where we started in 2005 doing exploration drilling and delineation drilling. It moved into grade control and production drilling in 2008, underground drilling, and then most recently, literally in the current quarter, we started earth moving services. We target customers with long life assets, low on the cash cost curve, and as I said, look to grow as the customer grows. And over time, expand the range of services that we can offer. The basic premise behind targeting the mine sites not only is to grow with the customer base, but is to enable us to build infrastructure on site. And then obviously the more services that we can deliver to the mine, the greater the operating leverage as we leverage the on-site infrastructure. It enables us to invest in our business, to grow, to train, and has led to the generation of industry-leading margins as we improve our performance, which comes about through longevity. Just some high-level numbers just to give an overview of the company on a revenue basis, looking at the 2020 revenue splits. So geographically, we are predominantly Africa, as per the introduction, with about a third of the revenue coming out of Middle East, North Africa, dominated by Egypt, a third of the revenue coming out of Tanzania, and 1/3 coming out of West Africa. And West Africa has been quite a success story for us in the last few years. If we went back about 4 years or so, it was about 10% of our revenue. We've made a concerted effort over the past 2 to 3 years and moved 30 additional rigs into the region. So we now have 41 rigs in West Africa, and we've seen very strong growth in the revenue contribution over the last couple of years. Excuse me. Services, look, we are still dominated by our drilling revenues, 87% of 2020 revenue, with the non-drilling activities being dominated by our fledgling earth moving business and our mineral analytical business. The non-drilling portion of the revenue is set to grow significantly in the 2021 year. We'll get into the contracts a little later in the presentation, but we have secured the largest contracts that we have ever secured for both the laboratory business and the earth moving business, and that's going to drive the non-drilling revenue growth in the current year. The activity part pie chart basically just breaks down our drilling activity in a bit more detail. And this comes back to the thematic about delivering the services at the mine site. So you'll see the dark blue is the production drilling, and the one to its left is underground, all mine site activity. The delineation drilling, which is effectively extending the ore bodies that are being mined at the mine sites, are also a significant portion of our revenue. So again, focusing on mine site-based revenue for consistency. And then finally, location, we just look at it holistically, mine site versus non-mine site. And as you can see, mine site revenue, 93% of the 2020 revenue. There's an important point to flesh out with that when you look at the peers, our drilling peers listed predominantly on the ASX and TSX, and they all had either flat to declining revenues in 2020, whereas Capital had 18% revenue growth, and that underlines the strategy of the group. So as COVID hit last year, obviously that led to travel restrictions and it led to a curtailing of field-based activities. But at the mine sites, because it led to a spike in the gold price, that obviously flowed through to operating margins for the producers, which therefore led to an increase in services. And we had no major productivity disruptions due to COVID, from the simple fact that it's a very well-controlled environment on a mine site. Specifically, there's one gate in and one gate out. You have quarantine procedures before you head onto the mine. You have regular health checks. So as a result, as I said, we grew our revenue while the sector actually had flat to declining revenue. So very pleasing to see the validation of the operating model. This slide gives an overview of the long-term contract portfolio that Capital has, and as I said earlier, 93% of our revenue is coming from these contracts. The pleasing aspect, a couple of pleasing aspects here, is that last year we added a further 2. So last year this was 8. We've moved it to 10 long-term contracts. The additions in 2020 were Firefinch in Mali. Firefinch purchased the Morila gold mine off Barrick. and we have started a 2-year drilling contract with them. And obviously, we hope to grow our services as they recommission that mine. And then in East Africa, we added the Bulyanhulu gold mine with Barrick. We started there in early 2020 with a deep hole, 2.5-kilometre deep hole delineation program designed to look for extensions to the ore body, underground extensions to the ore body. And then later in the year, we won a 2-year grade control program, as well as a 5-year laboratory services contract, And again, cements the model of opening our services with one service and adding services. Some other significant points to make here is being on the mine sites actually embeds us in the mining process and makes us, it provides much greater recurring revenue, visibility on your earnings, because you become embedded in the day-to-day functioning of the operations. And to bring that point out, we have recently, last week actually, just before we announced the full year results, announced contract extensions at the Gator Gold Mine for a further 3 years. Those contracts will take our tenure in 2024 out to 19 consecutive years operating at the Gator Gold Mine. Further to that point, last year in December, we announced a 4-year blast hole extension at Sukari and a 4-year contract mining earth moving contract. Again, that will take us out to 2024, at which point it will mark 20 consecutive years of service at the Sukari site. So outstanding duration in our book of business. This slide just gives a quick overview of Capital's fleet. As I said in the introduction, 94 rigs. There's going to be a lot of rig growth this year, predominantly driven by pre-announced contracts. 7 additional rigs going into Sukari. There's 6 additional underground rigs going into Tanzania between Gator and Bulyanhulu. And then we have some additional reverse circulation capacity going into West Africa and East Africa, given the increasing demand in the marketplace. On the right-hand side is a snapshot of our mining equipment, which is currently operating across 2 different sites, the Bonikro Gold Mine in Ivory Coast and the Sukari Gold Mine in Egypt. We have absolute highest quality standards with our asset fleet. It makes absolute sense when you're operating in more challenging jurisdictions without the infrastructure to support you mechanically to have newer assets. The average age of our rig fleet is about 5.5 years of age, and that is achieved through regular rebuilds, decommissioning of older rigs, and new asset purchases. And that is proved that basically drives higher asset availabilities and therefore higher operating performance. The final part of the introduction is our safety standards, and again, it fits with our mantra of being the premium quality provider to the industry. Highest safety stats, or the best safety stats, I should say, when you look at the TRIFR in comparison to our peers. Another outstanding year in 2020, numerous safety records across a number of sites, and as I said earlier, the COVID protocols were successfully implemented in 2020 and no major disruptions in what was a pretty challenging year. So just looking at the actual results and the highlights for 2020, I'm going to do this back to front. Financial, we'll start by saying an outstanding performance financially. We recorded revenue growth of up 18% to 135 million. That was right in the middle of our guidance that we set in January pre-COVID of 130 to 140. Our EBITDA was up 24%. Our EBIT was up 30%, demonstrating obviously the operating leverages that fed through the P&L. And our net profit increased 139%, which benefited not only from the strong operating performance, but also from some outstanding returns on our equity investments, where we booked gains of 13.6 million in 2020. The adjusted return on capital for the group was 22%, up 20% on 2019. And last week, we announced a final dividend of 1.3 cents a share, bringing the full year payout to 2.2, and that's a 57% year-on-year increase in the dividend. So look, on every measure, an outstanding financial performance in a particularly challenging year. Strategic and operational highlights, a lot of very significant ones. So looking at the core drilling business, we increased utilisation from 54 to 59%, and that was off the back of multiple contract wins with existing and new customers, and that includes 7 new mine site contracts, and as I said earlier, 2 new mine sites as part of that. But we also had some significant wins in our non-drilling business, the most significant of which was the transformational waste mining contract that we announced in December last year at Sukari, which involves an extension and expansion of our drilling activities. We're taking the fleet from 15 to 24 rigs, and we are deploying a significant mining fleet to operate to execute a waste stripping operation that will run out to 2024. As we said in December, that contract, the incremental value, the uptick on the existing business is worth circa 250 million over 4 years. Again, in context, last year we turned over $135 million, so a significant win to say the least. Our laboratory business won a 5-year services contract with Barrick in Tanzania, and multiple other wins on the lab side of the business as well. And as a result, non-drilling revenue increased from 8 to 13% and is set to increase materially higher in the current year. I'll now move into the results section. I won't spend too much time on this slide as we've covered the highlights, but I'll just make a quick comment on revenue. The revenue growth of 18%, it was pretty broad-based. The biggest driver was revenue growth on existing contracts, which I alluded to earlier, specifically higher gold prices contributing to improved operating margins, contributing to increase in demand for our services. We had a nice number of wins in West Africa, further solidifying that business as it continues to grow. Growth in our laboratory business. And I think the most pertinent point to take here is that the Q4 revenue was the strongest fourth quarter revenue that we have experienced since 2012. And that's a read-through that seems to be coming out from the commentary of some of our peers as well. And particularly pleasing is that momentum has flowed through into Q1 of 2021. Slide 13 outlines the group's margin profile, and we've had steady improvement in our margins for the last 4 years. We installed a new management team in 2017, greater rigor around our cost focus, and each year the margins have gradually improved, so very pleasing to see. Industry-leading margins, but the pricing is, look, we're a premium provider of service, but certainly pricing, not outsized pricing. The feature that really drives our margins is consistency. And it's back to the thematic of mine site-based contracts, long-term contracts, the tenure of most of the contracts between 2, 3 or 4 years. And consistency is the key thing that drives margins in this business. So where we achieved margin accretion in 2021, specifically improved maintenance practices, which include a lot of fleet standardization, improved supply chain efficiencies. We had a restructure of our supply chain function over the last couple of years, and that started to benefit margins. And then obviously improved asset utilization and the operating leverage that comes from it. Slide 14 looks at the cash flow for the group. Another very strong operating performance. The cash flows were up 25% year on year. EBITDA cash conversion was at 106%. So look at a very strong year, but obviously there's 2 fairly significant bars in this waterfall. One is CapEx and one is the equity raising. So I'll move to the next CapEx slide and just give some context around those numbers. Capital expenditure for the year was quite significantly up on prior years, but when you look at the pie chart, we've deliberately divided the 2020 CapEx into 2 sections. So let me start with the lower part of that pie chart, which is what we'd call ordinary course of business CapEx. And what this chart brings out is that the CapEx profile for the operating business of drilling and more recently analytical services continues to have a reasonably stable CapEx base and has been self-funding since we came to market in 2010. In the last year, we generated EBITDA of 33.8 million. Let's say 33 roughly of that came from the drilling and the laboratories operations, and CapEx for those businesses 19 million. So the core business, a core historical business, continues to be cash generative, cash flow positive, self-funding, and we expect that to continue as we move forward. But then obviously in December, we announced the award of the Sukari waste mining contract, and that requires $65 million worth of upfront CapEx. As you can see from the pie chart, we had spent and capitalised 30 million of that as at December 31. There's obviously another 35 to be expensed or capitalised, I should say, in this current year, noting that we had prepaid about 15 million of that at the end of December. And that CapEx obviously now sets up the platform for the core fleet to grow that business from moving forward. The balance sheet, I won't spend too much time on the detail here, just a couple of points to raise. So obviously the balance sheet has been upsized. In December, we came to market for a $30 million capital raising. We were strongly oversubscribed. We ended up accepting $40 million worth of demand. So that obviously had a positive impact on the strength of the balance sheet. Post-closing the contract, it was a concurrent event of announcing the contract and the capital raising triggered the crystallisation of the contract. We've then negotiated and finalised debt facilities with the OEMs on the rigs and Macquarie Bank on an asset-backed financing facility. On the bottom right, you can see the profile of the group where we have been net cash for the better part of the last 5 or 6 years. As we finish the capital requirements for the Sukari contract, in addition to the heavier rig build in 2021, the group will be moving into net debt. But we have consistently said to the market that if the right opportunity came along, we would be prepared to put debt on the balance sheet, provided A, it's a long-term contract, and B, that the debt then amortises down over the contract. We've stayed true to script. We've got the right term, right opportunity, 4-year contract, and we've structured the debt facilities such that they start amortising in the second half and are fully amortised over the duration of the contract. The investments was a very welcome gain in 2020. So just to outline how this strategy came about, it is something that is prevalent both in the earth-moving contracting sector and in the drilling sector, to occasionally take services, payment for services in the form of equity. In this case, we actually took a proactive stance, and this was back in 2019. We formed an investment committee as we were moving into West Africa. One thing that was very transparent to us is that there was an absolute lack of capital available to the junior and mid-tier mining and exploration companies, and we were moving capacity into West Africa. So we set up the investment committee, we screened the opportunities, we identified the companies that we thought looked attractive, and we made proactive approaches to these companies. We offered them what essentially were anchor orders to enable them to go and complete capital raisings, and off the back of those capital raisings, they could get back to work drilling again. And off the back of that came numerous contracts, preferred contractor status. In 2020, as the gold price improved, and as a number of these companies had some pretty successful results, that equity portfolio has revalued sharply, and we recorded gains of 13.6 million in 2020. And we also generated contract revenue of $18 million from the investee companies over the course of 2020, which continues into 2021. In 2020, we were less active. We actually were at slight cash inflows, so we were slightly on the net sell side with the portfolio. We have rationalised a number of the names. We'll continue to look at opportunities as they come, but obviously now with the capital markets well and truly open for the mining companies and exploration companies, the opportunity set is not as great as it was in 2019. Finally, on the financials, the dividend, I've already obviously stated the numbers. The dividend timetable is in the table on the bottom right. What the comment I would make is that the company has been paying dividends since 2014. We've got widespread investor support for that dividend and we'll continue to pay dividends moving forward. So now I'll move into the strategy and outlook. So when we look at the strategic priorities and where we can take capital over the next 4 or 5 years, there's 4 major verticals. One is growing the earth-moving contract mining business. The second is to grow the ancillary services revenue. The third is a continuation of the current theme to expand capacity with our existing customers. And finally, is to increase fleet utilisation of last year, noting we had 59% utilisation, so effectively 40 idle rigs in our drill rig fleet. So let's start with the mining contracting business. The Sukari contract, I've touched on this already, so I'll give an update of where this contract is at. We're about, these numbers are actually, believe it or not, even in the last week, a little bit dated. We're about 250 people into the hiring now, so sort of approaching the halfway mark. All of the equipment for stages 1, 2, and 3 has been purchased, noting that the project ramps up in quarters. It commences in Q1, moves to another level in Q2, another level in Q3, and hits the full run rate in Q4 of 2021. So stage 1 is now fully functioning. We commenced operating in February. We were marginally ahead of schedule, and it all going according to plan. Stage 2, all the major equipment is now on site and commissioning is underway of those assets, which should be achieved by the end of March, and again on schedule to commence production in Q2. And finally, stage 3, most of the equipment is in country, much of it on site, again on track for ramp up in Q3. So look, a pleasing start, no negative surprises, performing marginally, as I said, ahead of our expectations. So a good start to this contract, and critical for us in the earth moving contract mining business. This year is about execution. The Sukari contract is a large contract, well recognised within the industry, and it certainly put a flag in the sand for us to put our marker down, and the execution of this is absolutely critical because it will open up a lot of opportunities for us if we execute well, which I'm confident that we will do. Next growth is to continue to grow the ancillary services revenue. This is our maintenance services business, which does some outsourced maintenance and predominantly the analytical business. So the analytical business, mineral analytical business, we acquired this in 2017. We installed new management into the business, and we have expanded this aggressively in Africa in the last 2 years. So when we purchased this business, it had less than 10% of its sales coming out of Africa. Now more than 60% of sales are coming out of Africa. We've built labs in Mauritania, Nigeria, and we purchased a lab in the Ivory Coast, and now we are running laboratories for Kinross in Mauritania, Barrick in Tanzania, and we are commissioning and building a laboratory in Nigeria for Thor Exploration in the second half of this year. This business is still a reasonably small business in the context of capital. It turned over about $8 million last year, but the growth trajectory, again, is very strong. We're expecting revenue to double this year, and it's a nice business. It's a high margin, low capex business, high return business, and a perfect adjunct to a drilling business, because obviously the lead indicator for samples going through a laboratory is a drilling company. The next pillar of growth is basically to continue executing on expanding capacity with our existing customers. To give some sense about leveraging on-site infrastructure, we've included some photos in the deck, and they are pictures of our infrastructure at Sukari. And this is what we aim to achieve across all our sites: build substantial infrastructure to support the operations, look for longevity in the contracts, and look to expand the services that we offer. The projects in the bottom right, there's 5 there where we had an expansion of services in 2020. This year alone, we're expanding capacity at Sukari, obviously, and last week we announced the Gator contracts, which included an expansion of our underground rig capacity. We're also expanding capacity this year at the Bulyanhulu Gold Mine. And then finally, and this is the one that has actually surprised us pleasantly on the upside in 2021 thus far. And back to the earlier point I made, that the Q4 revenues were the strongest that we'd seen since Q4 2012. So we've come back to work in January, and the demand for our rig fleet has picked up very strongly. So what I might do is actually just go straight through to slide 28 to have a look at a thematic here. And that is on the top left is the gold price. And even despite the recent pullback in the gold price, it is still trading around decade highs. And more to the point, for the gold miners, if you'd said to them 2 or 3 years ago, would you be happy with $1,700 gold, they would have jumped at it. Their operating margins are very strong. Their profitability is very strong, and you see that borne out in their operating results. So balance sheets in our customer base are very strong. In the bottom left are the financings, and again, these are at 10-year highs. So when COVID came and the gold price spiked, there was a huge reopening of the capital markets to fund the junior and mid-tier companies, and that has continued unabated into 2021, but it's actually broadened into the battery metals and some of the base metals. So again, very, very positive signal, very strong lead indicator for a drilling business, because this capital invariably has been raised for project development and drilling activities. So where the disconnect lay, actually, one other thematic to point out, actually, before I move into it, is that these balance sheets have gotten stronger in the sector, and that has flowed through to widespread sector M&A activity. It started quite a few years ago with Barrick and Randgold merging, but even in the West Africa space, you've seen Endeavour Semafo, Endeavour Teranga, Resolute Mako, and the list goes on and on. So the basic premise, excuse me, I'll just have a quick drink. So the basic premise is that for a resource company to grow its asset base, there's 2 ways to do it. And they can either buy the resources, which is M&A activity, or they can go and find the resources, and that's exploration activity. And when you have a look at these charts, 10-year highs for commodity prices, 10-year highs for financing, yet exploration activity is half what it was 10 years ago. So there's been an enormous disconnect in the market. And over this time, a lot of the producers have actually been running down their assets from the point of view that they haven't been doing a lot of mine site exploration, which means each year of production is another year off the mine life. So now, as we've come back to work in January, we've been very pleasantly surprised with the level of demand that is coming through on the drilling side, which we think is a function of the 2021 budgets having been allocated and the companies coming out looking to spend those budgets. To put this in context, the top left is our rig fleet, which, as you can see, has been pretty steady for quite a few years now, but it's going to increase quite strongly in 2021. But at 59% utilization, that basically means we've got 40 idle rigs using a ballpark 100 as the year-end closing figure. Now, at the previous peak cycle, we were doing 80% utilization back in 2012, and the demand conditions that we're operating in at the moment are akin to the 2012 demand conditions, with one exception. It's the start of a cycle, whereas that was the end of a cycle. To put some context around these numbers, our drilling operations last year did revenue of $120 million out of the total of 135. If we're to turn on another 20 of our idle fleet, those rigs do, when they're fully working, about $2 million per annum in revenue. That's an incremental $40 million of revenue on the 120 just by turning on the existing assets. So to that point, we are starting to see that happening. So on this slide, this is the assortment of contracts that we have, contract wins and commencements in some cases, that we've announced in 2021. And if I was to show this slide 12 months ago, we would have probably seen about 3 of these tombstones. So it really has been the strongest start to a year that we have seen, with the strongest tendering market and activity market that we've seen really in the company's history. And it certainly sets a fantastic platform for the year ahead. I note that the broker consensus is running with utilisation rates of around about 66% for our rig fleet. Our next release to the capital markets is mid-April with a Q1 trading statement, and we certainly feel very comfortable with those numbers and with tailwinds currently in the marketplace. And what is also encouraging as the cycle is moving, it's starting to mature. So the rig utilisation is obviously starting to increase. It has been happening for quite a few years, but it's picking up pace at the moment. What happens then, the rig productivity increases, which basically means extended shifts, extended programs, instead of, particularly the exploration end, instead of 3-month programs, 6-month, 9-month programs. The rigs move to double shifting instead of single shifting. And then the next dynamic is pricing, and we are starting to see some pricing power come back to the contractors, and we're seeing improving rates on our new contracts. And that really is a broad thematic with contract terms and conditions also starting to improve. So this is the one that's more than anything surprised us pleasantly as we've entered 2021. And as I said, really strong trading conditions and strong tailwinds. So that then brings me to the outlook and guidance. A lot of these points I've covered, but just to reiterate, we've got gold and commodity prices trading at highly supportive levels. We've got surging equity market activity, which means in both cases, the balance sheets of the producers and the balance sheets of the explorers are strong as they have been for many years, and strong balance sheets tends to lead to increase in demand for services. So we've got demand accelerating. Demand is accelerating across all of our business units. And as I said earlier, we've announced multiple new contract wins already in 2021. We continue to work with a very strong balance sheet, which gives us the capacity to capitalise on these opportunities. And last week, when we issued our full year results, we issued our revenue guidance, which is 185 to 195 million in 2021. At the midpoint, that is up 41% year on year, continuing very strong growth in revenue. And at that, I'll hand back to the moderator.
That's great, Jamie. Thank you very much indeed for your update. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of the screen. But just while the company take a few moments to review investor questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet Company dashboard, and we will send you an email to notify you when they're ready for you to review. I'd also like to remind you that your feedback is important to the company, and immediately after the presentation has ended, you'll be redirected for the opportunity to provide feedback in order that the company can better understand your views and expectations, and would very much encourage you to do that if you can allocate a little bit of time. Jamie, obviously investors had the ability to pre-submit questions. We've got 4 that I'd like to start off the Q&A with, and then perhaps we can look at the questions that have come in the live event. The first question that we received is, what range do you have for gross profit margins? The 3-year average is 40%. Will that be achievable for full year 21? Or is the Sukari waste contract a lower margin contract, 30%, and will slightly lower the overall gross margin?
Thanks very much. I might actually get Rick. You can field this one. Thanks, Rick.
Sure. Thanks, Jamie. Okay, so as Jamie mentioned, we've guided revenue to 185 to 195 for 2021, so 190 in the midpoint. We don't provide specific guidance on margins. However, I would direct people to the consensus from the brokers. So our brokers are coming out with gross margins of about 37% for 2021, with an EBITDA margin of 26% for 2021. So we believe these levels are achievable. And then just as it pertains to the Sukari waste contract, look, we expect that contract to have broadly or achieve broadly similar margins to the rest of the group.
Thank you, Rick. The next question, the amounts in dispute with the tax authorities in Zambia, Tanzania and Mauritania are large. How much of management time in the last 12 months has been spent on trying to resolve these issues, and how concerned should shareholders be about unresolved tax issues?
Running through them, very little time on Zambia. We've not operated in the country for more than 5 years, and when we received the assessment, we strongly refuted the majority of the assessment. The areas of ambiguity we provisioned for, but very little activity is taking place on that front. Tanzania and Mauritania are obviously two countries that we're active in, and therefore have taken management time and focus, but more so the finance team, obviously more so than the senior management team. But with respect to the concerns about the unresolved, look, we have provided in our accounts for the tax disputes that we think are potential areas of exposure, and obviously, the notes to the accounts go through the detail, but we're comfortable that not significant exposure. These accounts have obviously been independently audited. So, look, it does certainly take some of management's time, but we're certainly not overly concerned. And as I said, we've provisioned for what we think potential exposure could be.
Thank you. There's a question around on Stockopedia around broker forecasts. The question reads, are these forecasts based solely on existing contracts based on the strength of your markets? Are you able to provide any guidance re 1, additional contract wins increasing guidance, and 2, ongoing revenue growth in subsequent years?
Any sort of broker forecast for a contractor are always going to have a mix of existing and new business, because obviously at any point in time there's certain contracts coming to an end. Now, when you look at us versus our peers, we've actually got a very large proportion of our book is long-term contracts. And to that point, the two biggest contracts or the two biggest clients we've had, Sukari, we've just re-signed with them for 4 years, and Gator, we've just re-signed with them for 3 years. And that's on top of multiple others, such as Bulyanhulu 2- and 5-year contracts recently signed in December. So there's always an element when you do your forward-looking forecast that you have to pick up some new business to replace contracts that are coming to an end. So what I would say is that for 2021, and we've announced numerous contracts, obviously, in recent weeks and with the release, that all of that business required to make the forecast for 2021 is now secured, which is a lovely position to be in this early in the year. And now it's all about execution. We've also got a strong level of coverage into 2022, noting that Sukari increases because that is its first full year run rate. It hits the run rate in Q4 of this year. And as I said, Sukari and Gator just having been renewed for 4 and 3 years gives us a high degree of visibility into 2022 and beyond as well.
That's great. And the final pre-submitted question, I know you touched on the investments that you have, but Capital have shareholdings in a number of listed and unlisted companies for which it undertakes work, obtained when mining companies were finding it much more difficult than currently in terms of attaining funding. While each of these may be a good investment in itself and may facilitate the winning of future business, they tie up capital which could be used by the company or returned to shareholders. What criteria do you have when applying decisions whether or not to retain these holdings?
Well, whether or not to retain the holdings is just a function of our expectations on future performance. And when we're looking at our capital allocation decisions, it's obviously whether it be in the form of a contract, then we'd look at the tender model and see what sort of return on capital we're going to get. We'd evaluate that obviously with the returns that we expect to get from our investments as well. So, it's an iterative process discussed within the management team and occasionally at the board level. As I said earlier, we have been a marginal net seller of those investments, but the group's return track record speaks for itself. I mean, we've averaged a 4-year return on capital of 19%, and that's pre the investments, and obviously the investments last year were absolutely outstanding. So, we'll assess each and every prospect on its own merit, obviously.
Thank you so much. Well, that takes care of the pre-submitted questions, Jamie, but I know you haven't had an awful lot of time to look at the questions that have come in, and thank you to all those investors that have submitted questions. And of course, any questions that we don't get round to answering, the company can review post the conclusion of this meeting. Perhaps I could just ask you to open up that Q&A tab, Jamie, Rick and Giles, and if I could ask you to perhaps read out the question, who it's from, and where appropriate to give a response, that'd be fantastic, and I'll pick up at the end.
I might just go the lucky last that's come in, Sam M, and it's for either Rick or Giles. The question is, the balance sheet looks quite solid, which it is, but your debt financing, despite being secured by assets, looks reasonably expensive. Macquarie at LIBOR plus 775. Do you think your debt's expensive?
Yeah, happy to take that one, Jamie. Look, I mean, the cost of the debt for us is partly a function of rolling out the new strategy and contract mining, and partly a function of jurisdiction. So I think the facilities we've got in place now, or the one referred to in the question there, was in place at the year end. We've just signed up a further facility with Macquarie now with a margin lower than the one in the question. We also got OEM facilities at margins below that as well. So I think, look, as things move forward, as the business gains critical mass, we fully expect that margin to come off with different facilities that we bring on, and get that cost of debt, the blended cost of debt of the group, down.
Okay, thank you. Next question from Bobby M. Does your mine site focus strategy, as well as the additional services, counteract the cyclicality of metal prices? Which I'll field that one. And my answer to it is yes, it does. I mean, we operate in an inherently cyclical industry. Everyone knows that commodities are. But by moving into the mine site strategy, and particularly focusing very carefully on the customers with whom we work for, and I could list off, North Mara, the Tassets, the Sakaris, the Gators. These are all companies producing gold in most cases the lowest cost quartile, sort of $700 to $800 per ounce. So therefore, if you see cyclicality and volatility in actual metal prices, and you look through, these companies continue, or the mine sites in particular, to continue to make very handsome profit margins. Whether it be $1,700 or $1,800 gold, they're still making very, very profitable margins. In fact, I saw Centimin's release, it was a 54% EBITDA margin when they released their results. So therefore, provided their balance sheets are strong, and they're enjoying those sorts of margins, the activity continues unabated despite the short-term volatility in the commodity prices. So the answer is yes. What it also allows us to do is invariably the mine site related contracts, the blast hole, grade control underground, because you're an essential part of the mine's infrastructure. These are longer term contracts. As I said earlier, 2, 3, 4 year contracts, and that again goes a long way to mitigate the cyclicality in the revenue. Another question here from Michael S. Post Sukari, what do you forecast CapEx going forward? Circa 25 million. I would say you're pretty spot on, or around about spot on with that number, Michael S. The Sukari CapEx, obviously, as I said earlier, will finish in the first half of this year, and that capital life on those assets is sort of roughly 10 odd years. The contract runs to 2024, so there's not a massive, no pressing need for additional CapEx to go in there. So then you're back just to the core business, and that number looks, somewhere between 20-25 million moving forward is around the right number. Bear with me, Rick. You can pick some out while I'm reading through, if you like. Oh, here's one from Stephen H. Would you sign other large contract mining contracts before seeing how you execute at Sukari? If not, what does that imply for the timing of any future contracts? The answer is yes. We would consider for the right opportunity, but the fact that we're already in March, and Sukari, as I said, has now commenced phase 1, and phase 2 is due to commence shortly in Q2. These earth moving contracts, these are 6 to 9 month tendering processes. They're extremely complex tendering processes. So even if one was to be signed, this wouldn't kick off until the end of the year. So we're certainly, do we think we have the capacity? Yes, but I'll go back to an earlier point. The focus right now is on execution, which I think is the angle of the question. We've got to make sure we get Sukari right. We've hired a team of really well-regarded mining people. As I said, it's performing exactly to plan at this stage. So execution is the absolute priority number 1 for us. Stephen H. The chart of ARPOR v utilisation surprising. ARPOR was not high when utilisation was. Now that I'm assuming is going back about a decade ago, potentially. I mean, at the moment, the ARPOR has actually been very steady for us. I mean, it's been marginally decreasing in the last couple of years, but that's a function of we got very solid ARPOR of our base business of blast hole, grade control and underground, back on the thematic, long-term contracts, very stable revenue, driving a very stable ARPOR. As the rigs come back to work, you start on exploration jobs, which are more start-stop in nature, in some cases just single shifting. But back on the point I raised earlier, as those jobs mature, which is starting to happen now, those single shifting jobs become double shifting, and invariably early stage exploration like air core drilling moves into the mid-cycle reverse circulation drilling and drum and core drilling, all of which is positive for ARPOR. Not to mention, of course, as pricing starts to improve, that feeds directly through to ARPOR. So typically the way it moves is utilisation moves first, ARPOR dips a little as you have less consistent operations. As utilisation keeps picking up, ARPOR then starts to trend up and attach back to utilisation and move with it. Afan N, can you shed some light on the state of the share price? Why did my eyes turn to this one? We're perplexed. We're trading at about, I think at about 3.2 times EBITDA. There is a comparative, well, let's look at the drillers in Toronto. There's Major Drilling trades at 11 times EBITDA. There's a company in Australia called DDH1, which has a fleet of almost exactly the same fleet rig count as us, 96 rigs, similar revenue profile, similar margin profile. Excuse me, there's drilling in the background rather inconveniently. And they just raised money. They went to an IPO and they raised money at 5.3 times EBITDA. So it's a difficult one for us to understand. We've got the highest quality customer list you could have. We've got, I think, across any of the drillers, we've got the longest duration contracts in our portfolio. We have the highest margins out of any of the drillers. We've got a very strong balance sheet. So look, we're not too sure why the share price is where it's at, but we hope if we continue to deliver these results that we'll start to get a bit of a re-rate. Ketan P, how confident are you on the political situation in Mali? Have you experienced any pressure on mining leases? Obviously, any change of government, and in this case, a military change, brings with it a degree of uncertainty. But I have to say that the change last year was really had very limited impact on any of the operations day to day. You certainly had some disruption in the government departments and I'm literally talking a couple of days before it was business, everything back to normal. So no real major cause for concern there. I mean, 2020 was an interesting year. There was elections in Tanzania, Guinea, Ivory Coast, a new government in Mauritania, a military intervention in Mali. So, you couldn't have had more disruption politically across the jurisdictions that we operate in. Yet again, we had one of the strongest years that we've ever had in the company's history. Julian H, what is the USP of MSA Labs proposition, and what should we think about the scalability of the business in terms of contract wins and margin uplift? Let me tackle margin uplift first of all. These are very high margin businesses, and they're all about getting scale of volume through the centralized lab. We bought this business. It was only turning over a couple of $1 million per annum, and really what we were buying was the barriers to entry. These are QA/QC ISO rated businesses with software platforms that have high barriers to entry. After acquiring the business, we then, as I said earlier, expanded it into Africa. And last year, it went from EBITDA negative to EBITDA positive. And in terms of its outlook, the CEO has actually just been in Egypt, now in Mali, and the list of opportunities is significant. So scalability, look, we're expecting revenue to double this year, and on a 5-year basis, the strategy plan looking for a target of up to $50 million in revenue. As I said, very high margin businesses, they're lower capital intensity, and it's modular CapEx. So really nice businesses to own. And as I said earlier as well, a perfect adjunct for a drilling company, and no surprises that MSA Labs has grown off Capital's customer base. So what's the USP? The cross-selling between the two businesses. I mean, we really, instead of a business that's run by chemists, if I can say that, we've got a lab business run by people who actually understand and are part of the mining industry.
I think, Jamie, just to add to that, one of the other USPs of MSA that's coming to the fore, and a big part of the strategy going forward would be the sort of impact of new technology on the turnaround times in the labs, and I think that's going to be a big selling point for the business is basically reducing those turnaround times and gain market share through a much more operationally sort of better offering.
Yeah, thanks, Rick. Mark S, what's the current spare capacity in the rig fleet by type? Are these largely the type of rigs used for exploration rather than production? Short answer is yes, largely. And that's why I spent some time on that slides looking at the utilisation and those contract wins, because what we're seeing at the moment is the exploration delineation rigs going back to work, and that's got a number of benefits. The one I obviously stated at the time is putting idle equipment back to work and the operating leverage that comes from that. But it also is the lead indicator for future business. And I'll go back to that analogy with Sukari, starting there in 2005 with a few rigs on the surface doing delineation, and was still there 20 years later doing all sorts of services. And as this activity picks up again, this is the lead indicator to start to grow with some new opportunities like that. Would you consider share buybacks if the weakened share price doesn't reflect the value of the business? Look, we're open to all things. It's always a question of weighing up the demand for capital between opportunities to grow the business and put scale in the business, and then obviously looking at returns from the optimal use of return on capital. So look, we're certainly open-minded to it. It's not something that's had deep discussions, but one of the conundrums that we faced in the last few years pre that equity issuance is that we really didn't have a lot of turnover in the stock, and it was quite illiquid. So it would have just compounded that lack of liquidity, but that problem's obviously gone away to a degree since the equity issuance. So look, possibility, certainly not something that's immediately on the radar. Look, that sort of brings us to an hour, and we've got to do another investor call. So I think I'll use this opportunity to wrap things up. I want to thank everyone for submitting all the questions. And thank everyone for dialing in. Appreciate it.
Jamie, Rick, Giles, thank you ever so much for your presentation and for a very inclusive Q&A. And thank you to the investors also for submitting those questions. Can I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide feedback. If you access this meeting from our website, the feedback page will appear. But if you access this meeting via the link sent you by email, you'll simply be asked to log back in order to submit your feedback. And if you could give the company that time, that would be most grateful. On behalf of the management team of Capital Limited, I'd like to thank you very much indeed for attending today's presentation. That now concludes today's session, and good morning to you all.